My name's Darius McDermott from Chelsea Financial Services, and I'm delighted to be joined this morning by Alex Ross, manager of the Premier Miton Pan-European Property Fund. Good morning, Alex.
Good morning, Darius.
So let's get straight into this. The fund invests in shares of companies that are related to property. Can you give us a bit more detail here? What type of companies would they be? Is that house builders or what type of property company?
So this fund invests in listed property companies listed on the equity markets across both UK and continental Europe. And typically these companies would be owners of real estate. So these would be the landlords who both collect the rents and also develop or regenerate properties. So mainly through the ownership of real estate. And within that, we invest in multiple subsectors. So that would be investing in quoted residential property companies. So that's rented residential typically. Office companies, logistics companies, some elements of retail, and also some of the alternative sectors such as healthcare companies as well. So multiple diversification within that. And I think just the other point being is the benefits of investing in stock market listed companies, which we do rather than investing in physical property companies, is liquidity you have. So these are stock market listed equities. So it means that we can move very quickly between UK, continental Europe, or between residential, offices, retail, for example, according to where we see the best returns from those particular subsectors. Plus the diversification benefits you get and the transparency cost, of course, of equity listed investments.
Now, I noticed that your largest country weighting is Germany. Tell us a little bit about that, because I think culturally they are more of a renting society than a house ownership society. Tell us a bit about that.
Yes, indeed. So most of our exposure in Germany is through the residential market. And we've been big fans of German residential for a long time, and we continue to see a very positive outlook for this subset. And the key reasons being why we like German residential, why we're so constructive on it, is it hits the three key requirements we look for investments in terms of supply, demand, and affordability. And if you look at those three elements, supply is very low of residential housing in Germany. And mainly reason being is that, for example, most of the residential housing that we invest in is valued materially below its replacement cost. And what that means, of course, is very difficult for developers to build new products at the same sort of rental level. So it just means there's very little new supply coming on, which means you've got a very resilient income from that. And then I think you also look at the demand side of things. There's more household formations than in Germany. Young people want to be in Germany, move to Germany, so you see net migration still towards Germany. And the affordability is still very good as well. So we see an ongoing rental growth market there. And indeed, one of the reasons we particularly like Germany in this type of environment is you go back to 2007, 2009, and we still saw rental growth in that market because rents are regulated. So you just get a very smooth
steady uplift.
Market. Exactly. Unlike in the UK, for example, where you have a much more volatile rental market. So it's a very stable income, and that gives good visibility to our income.
We've had a tremendously interesting year for all asset classes, and property is no different. And I see you've got about a quarter of the fund invested in offices. How's your view on offices given the newfound working from home culture that we've all had to adapt to in 2020?
Yeah, it's obviously a subset which is seeing huge debate in terms of the outlook going forward. And we think that working from home is going to be very much entrenched in working practices going forward. We think that there's going to be significantly less office space required going forward. So, for example, we think there's probably going to be less, perhaps 10 to 20% less office space required overall, which theoretically should mean a very weak office market. But we think you've got to be incredibly bottom up in terms of your analysis of the office market today, because we think there's going to be huge divergence between the different type of offices and how they will perform in rents. So just for example, we think that you split the grade B and the grade A market. So the poorer quality old office buildings. So this would be your generic office space, banks of rows of workstations, typically in older office buildings. We think there's going to be very low demand for that. We think there'll be a flight to quality. We think that perhaps a lot of corporates will want to have less space but focus on better quality space. So we think they'll want to take energy efficient buildings with good amenities, close to transport hubs, which of course then facilitate a flexible workforce where they can come in on typically a 2, 3 or 4 day week working practice, whichever works between the employer and the employee. So as a result of that, we think there's going to be a bit of increased demand for those grade A offices. And you look at the what's happening on supply and vacancy. So vacancy in grade A offices in the markets we're in, which is mainly Paris, Stockholm, Berlin, London, bit of Madrid. Grade A vacancy, those best-in-class buildings, is around. It's typically around its record low levels, at around about 3 to 5%. And of course, very few people are going to build new office buildings today. So we think there's going to be an interesting bounce back in recovery in those markets. And the nice thing about investing in the stock market is that we can access those best-in-class office buildings today at material discounts to their current asset values. Because, of course, there's so much uncertainty of the outlook. And we think that selectively there's great opportunities. And that's where we're focused on that quarter of the fund.
Well, that's a nice segue then into outlook. Maybe if you could say a word or two on outlook for 2021. And then if you dare to be a little braver, the outlook for a slightly longer period of time for listed property, please, in Europe and UK.
Yeah, sure. So I think in the short term, we think we're quite focused on the portfolio and the structure. We've got roughly 2/3 of the portfolio in what we see as structural beneficiaries of this crisis and what's going to happen going forward. So we've got approximately 2/3 of the fund in German residential, in logistics, in healthcare, self-storage. All those subsectors are seeing structural growth in their rental income due to the various different demand dynamics. So we've got roughly 2/3 of the fund where we think that rents are going to continue to move up, very good visibility towards that. And then we've got this 1/3 of the fund in mainly offices, but also a very small bit of retail. And that retail is mainly focused towards grocery and convenience, which is one area of the retail market we think will be okay. We have very little exposure to fashion retail, for example, where we think rent's going to be materially falling. But that 1/3 segment we've got in the offices and selective retail, we own at material discounts to asset value. And we think as the market normalizes and we see a return to the utilization of office space, for example, we think that there's good scope for recovery. So we've got structural growth 2/3, 1/3 in recovery prospect vehicles selectively, which we think there's going to be a good outcome to.
And of course, we must not forget the other reason to own property as an asset class, whether listed or whatever, is of course the income and the dividend. The dividend on your fund has actually held up quite nicely at around sort of 3%. How's that managed to happen in a year where you would have thought rents were challenged for landlords and rental holidays and all those sorts of things? That's really quite a good result for people in your fund.
Yeah, it's a good point because you look at that, as you rightly point out, the key fundamental of real estate is income. And whilst we look for capital growth as well from a lot of real estate, that income is good quality buildings we invest in. So these are sort of the leading residential, the leading logistics assets. So the Amazon warehouses, for example, last mile logistics warehouses for those smaller parcels to be delivered. Incredibly strong demand for those assets. So we've seen good dividend delivery from all those companies through the crisis. The 1/3 we got in offices and retail. Retail, a lot of that has been postponed, not surprisingly, given the lockdown, although our groceries continue to pay. But the 1/3 in offices as well, which we think that the income on that is going to be highly sustainable, mainly because we're focused on those leading grade A offices in those major cities, which are let to major corporates. Now, that is contracted income. And while some of the dividends might have been deferred for those office buildings, we think there's good prospects for that income to come through in the following year. So, it comes back to the fact that, if you're investing in good quality real estate, good quality tenants, and that all comes through in our intensive investment process, that income is pretty secure. And ultimately, that's what makes us constructive on the outlook, because if you look at the environment we're heading into as a result of this crisis, interest rates expectations can likely to be lower for longer. Yeah. At the same time, if this vaccine does come through successfully, we should see some economic growth going forward. And that is an incredibly attractive outlook for real estate, despite the sentiment towards the sector. Because, of course, if you've got low interest rates and an improving economy, that should see dividend growth and therefore lead for good performance going forward.
Alex, thank you very much for a run through on listed property, both in the UK and Europe. That was really interesting. Thank you very much.
Thank you for your time, Darius.
For more information on the Premier Miton Pan-European Property Fund, please visit chelseafs.co.uk.